this is on the fly. This is with no practice.
Mm-mm.
We're just this might be a recording.
Yeah,
This might be a broadcast.
I like that.
Okay, so what are we talking about?
Homeowners insurance. Homeowners insurance as portrayed by the New York Times and the underlying National Bureau of Economic Research paper that we read
Okay,
that got turned into a New York Times article.
yeah.
It's basically about the variation in homeowners price by geography, pointing out some weird range borders where one town over people are paying twice as much and the overall increases in homeowners insurance, etc. And the data used in it was pretty novel and interesting.
Well, you've done this. You've done lots of number crunching, filing.
I have.
Um, in your opinion, what was so unique about how they did this?
Okay, so I'm sort of fascinated. So I have to admit that I have this secret hobby of like reading the underlying papers that academics write about insurance because
Do
they
you
know
have
things I don't know.
do
Yeah,
you, do you have like a bookcase full of yellow books?
not anymore. I mean, it's all electronic now, Nick. I can read it on my iPhone as I'm trying to go to bed at night. It's fantastic, you know, but yes. But one of the things I find fascinating is that oftentimes academics, usually, economists, but other professions as well, are incredibly smart about things that I don't know how to do. And yet sometimes there's a piece that's just missing in their cleverness of kind of where the rubber hits the road, real world insurance stuff. And that's why I find this fascinating. So the title of the paper, I actually have it in front of me. Let's give due credit where credit is due.
You want to
Is
share?
interesting.
You want to
Yeah,
share
I
the
will
screen?
share. Let me share this, get to the first page. Here we go. All right, I'm going to pop up a share. All right, so this is a working paper. It is called Property Insurance and Disaster Risk, New Evidence from Mortgage Escrow Data by, I presume, Dr. Benjamin Keys and Dr. Philip Mulder. Fascinating paper. So what these two scholars have done is they have taken data from mortgage companies. So lots of Americans, when they pay their mortgage, their homeowners insurance, which is required by their lender, is a piece of that payment. And they've gotten a hold of that data, which covers millions and millions of households over time, and use that to look at variances in homeowners insurance payments, both in time series and from state to state and locality to locality, since they had the
Mhm.
home value, they had the exact location, they had what people were paying for homeowners insurance over time. And they found a few things. This actually got turned into a New York Times article. Let's give complete credit where credit is due. This is the article. It has a definite point of view, as you can see, how the home insurance market became so distorted. Climate change and widely varied state regulations could mean you're paying too much or far too little to insure your home. This is by Christopher Flavel. Definitely a point of view. I assume he did not write the headline. The article itself is a little bit more modulated. But essentially, if you look at this article, there's a bunch of, let's see. Oh, it's in the other, there's a companion map. Unfortunately, you can see what my internet shopping looks like. Let me hide my floating controls. I know.
And what AI tools you use to
Yes.
to read the pages.
Yes. Far too many tools, right?
Yeah.
Okay, so there's this map that they've built off of the data. The New York Times used the underlying data to build this. And what they're showing is what the average homeowner's premium is. So as an insurance person, I don't know, what do you see when you look at this, Nick? You're a property underwriter by training, right? Like you know
Yeah.
this stuff backwards and forwards. So what do
Yeah.
you
Um, I'm surprised at the degree of darkness in the middle of the country.
Yeah.
I'm surprised at the lack of darkness in California. Florida
Yep.
seems about right. And then there's that rogue county in New York
Yeah,
that's
what's going on
that's
here,
getting
right?
that's getting devastated, Lake George or whatever.
Hamilton County, New York, 3,500 dollars a year in homeowners insurance. It does say few observations, so few observations state average shown. So I assume there's some enough data there in upstate New York. Okay, yeah. So I kind of see the same thing, and I can see where the New York Times writer is actually getting his point. He's sort of saying that, hey, the issue here is that climate change is driving insurance prices up, and because of the way state regulators can approve or deny rate increases, your state regulators are in part responsible for your homeowner's insurance premiums. Which to some degree, fair enough.
Technically.
Yeah, I would say that's very much true, but nuanced, right? So, like, take California, right? Yes, the California DOI has kept homeowners insurance rate increases low for a variety of years, but I wouldn't necessarily call that successful past regulation, you know?
Oh, completely. We just Valkyrie Holmes just had a meme of, it was the Rock meme, and Rock's driving a taxi or something, and there's a kid in the back seat, and Rock's like, well, when we find a policy with high homeowners risk, we'll just non-renew it. And the kid in the back seat says, well, California just passed a law that says you can't do that. And there's that befuddled look by the Rock, like, what you talking about? Sort of thing. Yeah. And I commented, short-term fix with long-term implications.
Very, very much so. So what's interesting is in the underlying paper that this was based on, the scholars found that about 2/3 of the rate increases for homeowners insurance over time are actually due to increases in reinsurance pricing, which is, I was surprised that it was that big. So the New York Times report said as, hey, since 2019, the average homeowners insurance has gone up 33%. So I took a look at that and I actually broke that down because I was like, wait a minute, when you're like, oh, over 5 years, it increased by this huge amount, it sounds enormous. And it is a stiff increase, but it's about 7.5% a year, which actually does not shock me given what we've seen with fires and flooding and all of this and that. But I think the reinsurance piece of this is fascinating because my assumption is that the vast majority of what's getting passed along to reinsurers is catastrophic risk. And reinsurers are much less regulated than kind of the primary insurance market, right? I mean, the state commissioners of insurance do have some light regulatory control, but not really a lot. And so the capital markets do what the capital markets do when the reinsurers need to charge what they need to charge in order to remain adequately capitalized in a going concern. And so, yeah, that gets passed right back down to consumers. And that's not an easy
Cost
problem
of
to
doing
solve.
business.
Yeah, it is, right? And there is also the the literature review piece of the paper goes through prior literature that does show that capital market fluctuations do have an effect on availability and cost of primary insurance, which makes sense, right? Like none of us are surprised in the industry.
Well, none of us are surprised. I think a lot of people are surprised in general, because I learned this in my really foolhardy conversations I have with lemonade investors
On
who,
Twitter, I think I've read a few of those. Or
yes,
X, sorry,
yeah,
X.
ridiculous of me to participate,
I'm
but
cheering for you from the sidelines because you're not wrong. You know?
but that has always been my case is like there's only so much operational efficiency you can squeeze out of this. At the end of the day, what drives insurers costs are capital costs,
Yeah.
reinsurance costs, cost of capital, and distribution.
Yeah.
I think ultimately the cost to get a portfolio, build a portfolio, and all of the associated cost, sales and marketing costs around that. And so capital's huge. Like
Yeah.
and anywhere where there's cat exposure, I think cat costs, risk loads
Yeah.
are the driving factor.
Yeah, it's interesting to me. So my career, I didn't start my career in insurance. I actually started in telecommunications for about 5 years before coming to insurance. And as an insurance consumer, as I was in those days, I was a little bit like, that like parable of the elephant. Like if you can't see the elephant, but you can feel the trunk, then you think that an elephant is a snake,
Yeah.
right? And like it gets very deceiving. And I think that common consumer perception is that the business of insurance is selling insurance coverage and then settling claims with varying degrees of fidelity. And that is true, but it is one piece of the insurance business. There's almost like two totally separate businesses within insurance that are mutually dependent on each other. There is the operations, which often insurance companies make no money on, right? Often their underwriting results are essentially they pay out every dollar that they bring in on the operational side. We're very close to that. And then there's an investment side of the operation where insurance companies take these billions and billions and billions of premium dollars that they're holding for some period of time, right, against losses. And they invest those largely in safe portfolios, bonds, some stocks, some alternative investments, that sort of thing. But if they don't make a return on that portfolio, then the company doesn't make money as a whole. And if they don't make money as a whole, investors don't keep pumping money and they have other places to go put their money, especially in the US, especially when you're talking about publicly traded insurance companies. And so if they don't maintain adequate return on capital, they die, right? And then they can't pay claims, right? And then you end up with solvency issues and everything else. And I think I didn't even see as a consumer that whole financial piece of this or investment piece of this, and that is a key driving factor in what your homeowners rates end up being. Like your insurance company cannot simply take a loss year after year after year, right? And
Right.
that's what's sort of wild. One thing I thought was interesting that the New York Times writer did, it was actually a relatively smart article. Sometimes in the press you see things like all insurance companies are evil and bad, and it's not nuanced. This was a fairly nuanced article for a short piece. One of the things he pointed out was that proper setting of insurance premiums matching risk to rate actually drives behavior that is good for all of us. So, for example, if people are allowed to build right on the beach in Florida, and the insurance regulations keep their rates relatively low, guarantee the next time a hurricane comes through, that house is going to have a whole lot of damage, right? And we're going to end up paying out. When in reality, if that house was charged appropriately for where they're sitting right on the beach, they might not choose to build there in the first place, or they might build something that's more defensible for natural disasters, that sort of thing, right? And so when that part of the market fails, we actually all end up paying more.
There's a lot of hand wringing here in Florida
Yeah,
because we pay, like 4 times the national average or something like that.
yeah,
And there's like complete hand wringing, and my words around, well, we have half of the hurricane risk, and we just came out of a litigation abuse crisis,
yeah,
right?
you did.
Rings flat, especially with like
Yep.
consumer protection outfits
Yeah,
who just view any rate increase,
right.
any deviation above average as abnormal, unusual, needs to be fixed. When in fact, I think if you were aggressively running the models, you might even determine that Florida is still underrated in pockets. And
Yeah,
like that's how complex it is and how political it,
yeah,
this whole process is, because at this level, when you go that long, I think California's going to be in a world of hurt. When you go
100%.
that long without having risk and premium match one another, the pain to quickly do it creates political incentives,
Yeah,
of
it
like,
absolutely does.
people are in
Hmm.
pain. I can run on this. I can win on this. And then I have to perform, which is to keep the rates down. So I will find money. I will
Yeah,
find a financial mechanism to to help amortize this
yeah.
particular problem. It's a really big problem.
Yeah, and I mean, I think the thing about it is that it's easy to paint the insurance companies as the bad guys. And
Yeah.
sometimes they are, right? Absolutely, there's
Yeah, of
occasional
course.
unethical behavior like any other industry. In general, having been in the industry my entire career, I've seen very little of that, right? But it's easy to paint especially the distant, executives who get paid a lot at big insurance companies as evil and bad, when the reality is that to some degree, insurance is the mechanism to account for our lack of dealing with climate change, our lack of assessing true risks associated with catastrophes like building too close to the coast, brush fire risks in California, that sort of thing, and our failure to implement local building codes that actually are reflective of the risk, right? And so insurance kind of falls into the stopgap to fix all of those things. And it actually does
A
work,
really good
but
point.
it's ugly, right? Yeah.
That's a really good point. I mean, again, here in Florida, you see the perversion that occurs,
Hmm.
um, the political perversion,
Yeah.
not the other kind. Although I'm,
I can't
I'm
speak to the other kind in Florida, but I am an observer of your politics, you know?
well, it's Florida. I'm sure there's plenty of all kinds. So when building codes are, when they come up at town meetings,
Yeah.
city council meetings, things like that, it's the builders who show
Yeah.
up in full force. And they're not just builders in Florida. It'll be like almost like the unionized trade associations from
Yeah.
Washington, D.C.
Yeah.
come
National
down,
companies,
right?
lobbyists, right? Yeah.
And and it's you can lie really well with statistics,
Yeah.
right? So they come down and they talk about like how this will be devastating to your economy because with these
Yeah.
stricter codes, the prices are going to go up on these properties. You're going to have
Yeah.
fewer, and they'll go down the cascade
Yeah. Yeah.
without doing the full cost benefit analysis. And
Right.
again, it's a short-term fix but
Right.
this creates long-term implications of
Yep.
the insurance gets unaffordable when you do
Yep.
that. And I think Florida, I think, is the natural sandbox for
Yeah.
for what's going to happen to the rest of the country because we're facing the crisis now,
Yes.
right? But the crisis is from litigation abuse and a whole bunch of other stuff. God
Yep.
help us, Kate, if we hadn't gone through the rigorous building code updates.
Yep.
This would it
It
would
would have
be
been a
it would
mess.
be unaffordable to own a property in Florida if we had not been that aggressive. And so
Yeah.
I think the lessons are that, and it does not have to be political. And I say this all the time. You can believe in climate change or you don't have to believe in climate change. It
Yep.
is irrelevant.
Yep.
Mother Nature has a crafty way of throwing curveballs at us.
Yep.
One thing I truly believe is with human ingenuity, we can engineer our way out of this. We can build properties that are wind resistant, flood resistant, fire
Yep.
resistant. We will make mistakes, but just look at how good that policy worked with the airline industry. And
Yes.
we have been in one the safest period
Yeah.
of airline of air travel ever. Why? It's because we screw up and we find out what we did and we
Yeah.
fix it. And we
Right.
screw up, we find out what we did and we fix it. And we just keep doing
Yep.
that. And over time, you just completely begin to eliminate these random things that could potentially happen. We really need that. I look at the Midwest, like look how
Yep.
dark
Yeah.
look
Look
how
at
dark
this.
that is. And I know
Yep.
for a fact that they don't have the building codes anywhere close to the state of Florida. And if they did,
Yeah.
it would not be this orange or this dark.
Yeah. So a lot of that is they haven't had to, right? Like before this sort of relatively new state of increased tornadoes, convective storms in some places, et cetera, it didn't matter that much, right? These were relatively peaceful areas, and every once in a while, a tornado would touch down and it wouldn't hit much necessarily because population density was different than what it is in some of these areas now. And also just the pattern of storms was different, right? And now you're intersecting these like horrible storms at greater frequency with greater strength in areas that, as you mentioned, were not built for this, right? One of the things the article is that the boundaries between some of these sort of between towns and between communities can mean that you live on the edge of a community and a house on one side pays, $1,000 for insurance, and a home on the other, the average home on the other side of the line pays $3,000. This is not a particularly steep one, but they'd picked out a couple of examples. I did think those were interesting, but I think I was thinking through catastrophe modeling and what would happen. I think a lot of this is an outcome of catastrophe modeling of various sorts, but what would happen if we didn't have it? And I was thinking a test case. So I'm up in Massachusetts, and there was a devastating tornado that hit the Springfield area a few years ago. Do you
I
remember
remember
that?
that. I
People,
do.
I mean, really uncommon in this area, or was uncommon. Now we're getting tornado warnings every summer, which I never remember as a kid. But devastating, destroyed a number of buildings, killed several people, really, really scary and unexpected. We certainly are not built to withstand that sort of storm because we don't get them. So, what do you do as an insurance company if your homeowner's book is, let's just say, entirely in Massachusetts? You can look at Springfield and you can say, oh, well, that's a place that got hit by a tornado. So, what I'm going to do is take the millions and millions and millions and millions of dollars of damage in Springfield, and I'm going to load that into my rates for the next 10 years. And if you do that, all of a sudden premiums in Springfield go from, I don't know, $1,500 a year to $8,000 a year. Now nobody wants to buy homes in Springfield because they're expensive to insure. The property values go down. Then what happens to families that have struggled to buy a home, or to the elderly who might have retired in a home they've owned their whole life and we're counting on that to pay for their end of life care, et cetera? And the reality is that the fact that a tornado hit Springfield once does not mean that the next tornado in Massachusetts is any more likely to be in Springfield versus Worcester or someplace else, right?
Yep.
So the insurers have to pay these out. And so they have to build these models that spread the risk. And the way they choose to create a location may be different from company to company, right? And that's part of what creates these sharp edges? Like, do you put, yeah, right? Go ahead, go
It,
ahead. You know,
it, it should, it should, for the audience sake,
yeah,
you are correct. They can build their models and their geographic boundaries any way they choose to, as long as it's meets the state
yeah,
requirements for fairness.
yeah,
But they can go as far down. I've seen in certain states where HCI, their Tip Tap outfit in
yeah.
Florida, pre-modeled every single home.
Amazing. Wow. Yeah,
So when a submission would come in from one of those homes, it was just a lookup and
yeah,
they'd get it. But you can go down to like census block, zip code, I think zip code for like fire and auto are probably the
yeah,
most common. You go,
yeah,
I'm on the boundary of one zip code to the other.
yeah,
So I'm in 34120.
yep,
Just on the other side of the traffic light is 34119.
yeah,
And my insurance went up like 50%
yeah.
moving from that over to this side.
It's wild, right? And then you get sort of a stacking effect because not all catastrophes are modeled together, right? So in an area that's exposed to, like, for example, Texas, you're going to get a hurricane model, right, or a wind model. You might have a separate tornado model depending on how you're building out your modeling. Wildfire may be a thing down there, perhaps not. There might be a little bit of earthquake modeling for additional earthquake coverage when people buy it. And you start stacking these different kinds of winter storms. Forgot about winter storms, right? We need to worry about that in Texas now. It's wild. And you start stacking these up and you just get rate oddities from community to community. And I mean, from my own experience building insurance products over the years, you can smooth to some extent, but it doesn't necessarily get you greater accuracy. It actually does the opposite, you know?
One
Yeah.
of the best stories I have around the trade-offs that you have to make
Yeah.
when it comes to these models was when I was at AIR, the second largest model vendor, and a reinsurance broker approached me and said, "We're seeing some odd
Uh-huh.
output from the models." And this
Okay.
was a New England regional insurance company that the
Okay.
reinsurance broker was modeling for.
Yep.
And so you had two homes in Connecticut that were maybe a kilometer apart,
Yep.
but the windstorm losses were double in one versus the other. So I dug in and
Yeah.
I ended up bringing the PhD who was head of the winter storm model.
Yeah.
And we went to a whiteboard and he basically
Yep.
said, Nick, when we build models, we have to make trade-offs. And
Yes.
so essentially what they do is they layer a grid on top of the earth with some sort of resolution. I think in this particular case, it might have been like 5 kilometers by 5 kilometers, 10
Yep.
kilometers. I don't remember exactly what it was.
Like small enough to be accurate, but large enough to have enough data. And that's the first balance there,
Right.
right?
And it'll actually run. You can put in 100,000 locations and it'll run. It won't take a month
Yeah.
to run that simulation.
Yeah.
So these properties are like a kilometer apart. So on the map, they looked really close to each other, but they were in two different grids. And one home was north facing on a hill. One
Oh.
home was south facing on a hill.
Uh-huh.
Literally for winter storm, you
Yeah.
north facing is going to get colder
Right. We
weather,
call them nor'easters for a reason up here.
right?
Right?
South
Yeah.
facing gets more sun. Um, and so the north facing property was doubled just for winter storm,
Yeah.
not for fire, not for liability, just for winter storm. It was double. And it was like, this was a year into my tenure at AIR. And like, that was such an awesome learning experience because I
Yeah.
got to see that it's like you can run the most sophisticated models, you will always get oddities. Like there are always blind spots
There
and other
are.
things that you just cannot account for. And they said like, we could smooth this out, but at the end of the day, when you're looking at a portfolio basis, it adds pennies.
Yeah. Yeah, it does. And then you lose your resolution. So which is it that you want,
Yeah.
right? And that's an art, not a science. There are wrong answers, but there
Yeah.
isn't a right answer, right? Yeah, here's an interesting aside that I learned recently. So you point out north facing homes as a risk, something that most homeowners probably never really think about. All we're thinking about is where the sun is in the kitchen, like what time of day is it light in here? But in New England, you can actually read the history of powerful nor'easters, like, the once in every 20-year storm, in the lean of old trees. So literally, if trees are like quite young and growing at the point when a heavy storm comes through, they end up at a little bit of a lean, and it's always to the southwest when it's caused by a nor'easter. So if they die or fall, or if you estimate from the width, the number of rings that it has, then the age that it is, you can actually read the history of severe weather in New England. Isn't
Yeah.
that wild?
It is wild. And I noticed that this, so I live in Southwest Florida, so we just had Debbie come
Yeah.
by and we got mostly rain, but
Yeah.
I was walking out and I was surprised at how many trees were leaning. And
Oh,
so it's
yeah.
like you can tell which way the wind was blowing or it
Yeah.
was blowing the hardest because there were trees leaning and those trees probably will not survive at some
No.
point because we don't get
Yeah.
1 in 20 year storms. We get them
No.
like
You get 1 in 20 year storms every year
every
these days,
year.
right? Yeah. Yeah, which is wild.
It's so interesting and I love how you brought up art and science.
Mm,
The with catastrophe models, it has to be grounded in solid science.
yes.
But that was what I sort of cut my teeth on and built my career on was the art
Yeah.
of it. Was
Yeah.
what are these numbers telling me and how can I arbitrage this?
Yeah.
So not only am I thinking, what are these numbers telling me? I'm thinking, what are these numbers telling everybody else? What do I think they think?
Yes.
And if I can correctly think what they're thinking, I can find the flaw in their thinking and
Yes.
then and outflank them.
And outflank them exactly because this is a game, and the company that is the most accurate over time, assuming they run their business effectively and ethically and all of that, will win, right? And that's why there's such a rush for big data and data science and modelers
Outflanking.
and sensors. Yeah, it's outflanking. That's absolutely what it is, right? It's a
Yeah.
competitive market.
Yeah. Um,
Um,
I just wrote a paper that's going to be coming out this fall for ERMI,
awesome. On
in
what?
their
Yeah.
captives group, right?
Yeah.
So the map that you brought up
Yeah.
in hindsight is not a surprise anymore. So
Mhm.
and once you start talking, I'll see if I can dig it up. So I got a look at the billion-dollar disasters by
Mhm.
peril
Mhm.
for this century,
Okay.
and everything is normal
Okay.
until the early part of the prior decade. And it
Uh,
was severe thunderstorm that just exploded off the charts. Like you can just see it, it's visually
mhm.
obvious. One thing I do with statistics is I relate everything to smoking, right? Like you can make any sort of correlation, but the smoking one was just so eye-popping, stands out.
Yeah.
Like everything changed, the world changed when everyone started smoking. Everything
Yep.
changed, right?
And
Like
changed again when everyone stopped smoking, which we can
exactly.
see in the
Like
data
you,
as
so
well,
you
right?
can see like, listen,
Yeah.
is some of this correlated? Maybe, maybe not, but there's something happening here.
Yes.
Okay. And you can see it in the insurance data as well, the billion-dollar losses. You saw the spike, right, in severe storm, and it has not relinquished. So
Yeah.
we are in like a 10-year cycle of
Mm.
the frequency of severe storms just off the
Mhm.
charts. But the what toppled and got us into this crisis was at the latter part of the prior decade, we started to see frequency pop up in wildfires. We started to see frequency pop up in hurricanes.
Mhm.
So during that period, we had a super quiet hurricane period, a super noisy, severe thunderstorm period, and that creates all sorts of issues around what the modeling vendors need to do, what the actuaries need to do,
Yeah.
regulators need to do, and where you do them. It's like juggling chainsaws.
Yeah. Well, and this goes back to what you said before, but I'm going to say it a little bit more obnoxiously, which is that, like the capital markets do not care what you personally believe about climate change. They do not care at all, right? All they want is for the companies that they're putting money in to make money. And to do that, insurance companies have to respond to
Yeah.
this.
So a conclusion that I came
Yeah.
out from this article that I wrote around captives
Yeah.
is it was essentially to tell property owners and captive managers, like, hey, listen, the property market may have structurally changed. So I go into the
Mhm.
definition of hard market and soft market and the
Yeah.
cycles.
Yeah.
And we've had these cycles of hard markets and soft markets. There's something unique about this particular hard market.
Mm-hmm.
Usually there's a flood of capital that comes in during the hard market to leverage and capitalize on the
Mm-hmm.
higher rates and the
Yeah.
supply demand issues. Not this time. We're not
Mm.
seeing it. And
What
not
do you think's
anywhere
driving that?
close to what we have seen in the past. And my
Mm-hmm.
personal belief is like, I think the markets have structurally changed. Like to your point, there is no mechanism in the regulations to price for climate change. There's
Mm-hmm.
no
Nope.
mechanism.
Nope.
There's no
It would
standard
not be
model.
allowed. You can't add like a climate change
You
surcharge.
can't. You
That's
can't
no part of
the
no part of the
the
regulation.
consumer protection groups would have a hissy fit, which is ironic, right? Because I read articles where they had a hissy fit saying Florida's not even charging for climate change, those dummies, right?
The same people arguing out of both sides of their mouths, and it's just I applaud what they are trying to do, but I wish they were doing it from a perspective that actually was doable and fixable and didn't leave us in an awful
Yeah.
situation of market
Yeah.
failure. Right. Yeah.
But again, I think Florida is the bellwether, the
Yeah.
beacon for it is the what comes out of Florida is hitting California right now, or it's
Yep.
already hit Louisiana, Texas. We're going to see
Yep.
it in New York. We're going to see it in
Yep.
these potentially cat-prone states. And I think what you're seeing is that the structure that you just showed is untenable. And
Totally.
so
Totally.
insurers, and this is advice when I do consulting gigs with like mutuals, like
Yeah.
if you do not have an E&S facility
Hmm.
on your board, you got to have one. It makes no sense for you to devote everything to the admitted market because a lot of the business that has fled the admitted market is
Yeah.
not coming back. It
So you
can't
know
come
what?
back.
I think a lot of people who've only had a career in personal lines are actually pretty unfamiliar with ENS and are going to learn a lot about it soon. Do you want to give a quick definition for people? Like, what does that mean?
Sure. So the markets that people are mostly familiar with in property casualty are auto and homeowners, right? And so the firms that you see advertising on TV, the State Farms, the Liberties, they have what are called admitted insurance capacity, meaning they have a license to do business in the state. In exchange for that license, the state creates a guarantee pool for those carriers. So if one of the insurers goes insolvent, there's a guarantee fund that can help pay off the remaining claims and try to shield and protect the other insurers. In exchange for that, that's creates I guess, the authority for the state regulators to aggressively regulate the insurance companies. Like you want access to this guarantee fund and you want the bar to be lowered in terms of how you can and can't sell insurance, you have to go through the admitted route. And for many states, we have to approve, the state has to approve what price you charge and the policy language that you use. And for many states, Massachusetts being one of them, Florida being another, you cannot just say we are clearly underpricing this. We have to raise our rates. You have to petition for the rate. You have to provide, 50 to 100 page documentation with actuarial tables, and then you still don't get to decide. The actuaries at the regulators decide. And that's why in California and in other states like Florida, you can go many, 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 many years without significant rate increases because the regulators will put a governor on top of it. The opposite of that is what's called surplus lines or excess and surplus lines business. Those companies also have authority to do business in the state, but they have no access to the guarantee fund. So brokers, for instance, shy away from selling excess and surplus lines in a lot of cases because they kind of like having that guarantee fund there so it doesn't hit their E&O should a company go insolvent. They like having that. By not having access to the guarantee fund, excess and surplus lines carriers are typically do not have a lot less regulation. They do not have to file and get their rates approved. They can charge whatever they want to charge, whenever they want to charge it, at any cycle they want to charge it. For the most part, they can use policy forms. Um, they can manuscript those policy forms to say whatever it is that they want. So it's kind of like the Wild West. And here in Florida, a lot of homeowners business has transitioned from these highly regulated, admitted markets to excess and surplus lines because it's
Yeah.
the only place that some homeowners can actually get any coverage. And it's usually Lloyd's of London and specialty insurers that are in that field. How did
And
I do?
that's really new, right? Because I mean, in the past, the excess and surplus market in the US, I want to say is about a third of the total insurance market, something like that, roughly. It's growing faster than the admitted market from everything I've
Lot
seen,
lot faster.
a lot faster. And in the past, that would have been kind of heavy industrial risks of various sorts, complex commercial risks, high net worth individuals, not like your buddy down the street's homeowners
Yeah,
insurance, right?
$100,000, $250,000
Yeah, that
property.
part's really new.
Maybe like a cabin in the woods, not near a fire station, not like miles and
Yeah,
miles away from a fire station. That's excess and surplus lines. Like that is
yeah,
if a fire starts, if
it's
frequency
up.
and severity are like equal.
Yeah, yeah,
The
yeah,
counts are equal. Like if a free
yeah,
if a fire happens in a cabin in the woods,
total.
the property's gone.
Yeah, yeah,
Sort of thing. So it's these unique cases that the admitted market didn't either like didn't have the data or the models or just the appetite,
yeah.
right? It to them, and you still see it today. So you still see, I'm quite familiar with how some mutuals in New England work, and
Mm,
most of them have like 2 mile buffer zones along the coast.
yeah,
I think it's a bit arbitrary, but
yeah.
for them, it's like if you're within 2 miles, we won't write you.
It's easy
So
to
coastal
communicate,
properties are a
right?
lot have a lot of E&S,
Yeah,
generally go in the E&S markets. Most
yeah.
admitted markets don't want to deal with it.
Well, the thing is, you can make a lot of money doing that because, for example, if you're on the Massachusetts coast, there are places that are at sea level that, are face the full brunt of every storm. And then there's homes that are, up on a hill, but maybe a little bit protected from the wind that might be great risks. You can write those all day. You don't have to pay for the burden of the heavy regulatory regime, and you can charge what you think is fair and update your prices as needed. I mean, you can also customize the coverage for that homeowner. Not a bad deal, quite frankly, right? So
Oh,
yeah,
I mean,
sorry for that side. Yeah.
so the conclusion I have
Yeah,
is that the market has structurally changed.
absolutely would
And
agree.
and my guess is it could be decades before it reorients itself
Yeah,
if we do go back. But I,
yeah,
I think it is structurally changed. And so I think whether you're a captive or a mutual
yeah,
or a farm bureau or anyone, you really need to have E&S capacity
uh-huh,
available, or else there's going to be a lot of business that walks
yeah,
out that door or that you're not going to want. And
yeah,
you have no other avenue to bring it back. And so I see E&S continuing to grow and then
yeah.
holding on to that business.
Yeah, one thing that I think is interesting, so in some states, well, in all states, I believe, for many kinds of risks that are traditional coverage, like heavily regulated personal auto, homeowners, these kinds of policies, there are specific rules for when the E&S market is allowed to step in. So it is that they can't access the guarantee fund, as Nick pointed out, but it's also that they often can't access the market unless certain conditions are met. So sometimes it's that a broker has tried the three ding rule, right? Like a
Yeah.
broker has tried three different standard admitted
Admitted.
markets for
Yeah.
their risk before they can quote in the excess and surplus lines markets. Other states maintain export lists that are certain kinds of policies, like it might be 2 miles from the coast or whatever, can automatically go to E&S. That whole regime probably needs to be modernized a bit as well, right? I mean,
Mm.
there's states where it's no big deal, but there are other states where that's highly, highly regulated.
I I couldn't agree more. I see Texas still has a stamping office.
I'm in Massachusetts where we still have stamps for auto insurance policies. They're digital, but I also have literal like ink pads and stamps for all our carriers. It's wild. Every
So
underwriting company has its own too. Box of stamps.
I think in terms of regulatory regimes, I think both sides, admitted
Yeah.
and surplus lines, the Florida Surplus Lines Office, I would say is cutting edge.
Is there really?
And
Well,
what,
they would
and
have
what
to be, right? I mean,
I
they've
think
managed to
so.
kind of turn the market around in a way that California kind of hasn't. Different situation, but not dissimilar in some ways.
In the way like they are very open with their books. Every month I get a newsletter.
Yeah.
The newsletter, it's almost like they're propositioning to me. Like they're telling
Yeah.
that they're transparent. They say
Yeah.
we
That's
we grew by
fantastic.
this much. Here are the lines of business that grew. Like very open
Yeah.
in what it is they're doing. And there's so much market intelligence there.
Yeah.
That has given me a clue that I think the market has structurally changed.
That's fascinating.
You know,
I
we
adore transparent governance as well. You know, like what
completely.
do we want? So I had two more brief topics that I wanted to touch on. One was I noticed a skew in the data for the New York Times article I wanted to point out. And the second was it might make sense to add a few things that consumers should do in light of all of this. Does that sound okay to you?
Yep.
All right, I'm going to pop the map back up here. So this is sort of a brilliant approach by the authors of the paper who created this data set in the sense that, as I mentioned before, they're using home insurance payments that are part of the mortgage payment, right? Because that's an accessible data set that they can get. They did note in the paper that when they tried to normalize the homes in their sample against databases of all of the homes in the US, the value of the homes in their sample was about 15% higher than the average home in the US. But they didn't really explore why. And I actually think there are two skews in the data working in opposite directions. One of which is that a very significant percentage of American homeowners own their home absolutely outright. I think it's like something like might be more, half of the people who own a home do not have a mortgage balance on them. And it's not because everybody like rolled up and wrote a $500,000 check. It's because if you bought your home in 1984 on a 30-year mortgage, it's paid off. So you got a lot of older people, by definition, in older homes, because they've been in those homes long enough to pay off typically a 30-year mortgage, that are then not in the data set. And we do know that some homeowners carriers do use age of homeowner or length of residency as a rating factor. So there's a skew introduced in the data that way. And then there's a second skew those are probably also on average lower value homes because they're older and smaller. We know that American buildings have gotten bigger over time, right? So that's important. But there's a skew the other direction as well, which is that I actually had to go and look up whose mortgage payments typically include insurance and whose don't. And the answer is that if you put down less than 20% on a home, your homeowner's insurance typically will be included in your mortgage payment. If you put down more than 20%, typically you get to make a choice, one way or the other. You pay the company, you have to have insurance. Lender wants that, but you either pay it directly or you don't. Well, the people who most definitely don't want to pay it directly are the people who want to get a paid in full discount, right? You know, if you pay your homeowners once a year in full, you typically get maybe a 10% discount, which is significant if you're talking about a $3,500 home insurance bill, right?
Yep.
People who have the money to pay $3,500 all at once for a year of insurance are rich, right? Richer than the average homeowner. So there's a wealth skew in here in the sense that you're leaving out probably the richest people have put down the highest down payments and who are paying their insurance in full. And that's just completely missing from this data. I don't know what percentage of homeowners that is, but it's definitely a skew in there. And that's also going to be different by geography, I would expect, just looking at kind of average income by locality, right? So kind of interesting and not
That
remarkable.
that's a
Authors.
skew. That's a skew. And as you were talking, I realized again the small more art than science kind of
Yeah.
viewing of this statistical data is they use average premium and
Mm-hmm.
not average rate.
Mm-hmm.
So
Mm-hmm.
that means property values are
Yep.
skewing this as well, which
Absolutely.
means the Nebraska, Colorado thing's even worse because
Yeah.
the properties in Florida are more expensive.
Mm-hmm. So they do have, interestingly, let's try to find an area where they do also do this piece where they take share of home value, which is interesting. So what percentage of your home value do you pay, which controls for that somewhat, but it's
Yeah, yeah.
it's sloppy, right? So yeah, I mean, I don't have a perfect data set. I'm not criticizing the work they've done. It's very interesting. I just am sort of saying, that's a skew that I'd want to like, as an insurance practitioner, before I took any of this at face value, I'd want to think through what that means, right?
I mean, this is the challenge with stuff like this is like,
Yeah.
what do we do with this? How do we interpret what potentially is going on there? And so you're exactly right. All of those factors have to be put into consideration.
Yeah. Yeah. It's fascinating. What should consumers do? I have a few thoughts. I bet you do too. What do you think? Shop,
Um,
shop, right?
shop, always shop, but
Shop.
I worry about consumer shopping
Yeah,
because
that too.
shopping just because of price.
Yep.
They are quite vulnerable to getting a lower price, but also lower coverage
Yep.
sort of thing. It's like, oh, it was $1,000 cheaper, but yeah, your deductible went from 1,000 to 10%.
Yeah.
In the long run, that's gonna cost you more.
Yeah.
So sh I'm gonna, I think I'm gonna be blunt here.
Yeah,
In most people are just completely ignorant around insurance.
I completely agree.
And they have much more knowledge about the stock market and finances.
Yep.
Even for the average person who I think has faulty knowledge about the stock market and how the market works, they know a
Yes.
lot more about it than they do
Well, yeah,
insurance.
and they're going to make fairly reasonable decisions like, oh, I'll try a low cost index fund, which may not be the smartest strategy out there, but it is not a bad strategy, right? Or maybe I'll save in tax advantage accounts like a 401k. Like that is not, that's a great
It's a
strategy,
great
right? Like those
strategy.
are
Yeah.
fine.
Index
The-
fund's a great
It's
strategy
great.
'cause
The
it's
average
proven.
insurance thing out there, though, is terrible, right? Like it's a
Because
terrible idea. Yeah.
it's the policy language, or language is difficult to read.
Yeah.
I mean, just in what we just discussed, premium versus rate. I mean,
Yep.
I get some of the arguments I have on LinkedIn with public adjusters are around Florida pays an average of 4 times the average premium, and it's like, but what causes that? Right?
Yeah.
Like that by itself is just a number. Like
No, yeah.
it could be the properties are a lot more expensive, and we get, half of the
Right.
hurricanes come here. And so the consumer just, I think, has no shot in try. I mean, it
No.
took us decades to
Yeah.
get comfortable
Yeah.
with stuff, and I still feel like I'm a stupid idiot when it comes to insurance. But I
That
would
bell
say,
curve where the people on the top and the bottom are both like, whoa, this is hard, right? You
yeah,
know?
I
Yeah.
I
Yeah.
would say my biggest thing that I hope we move
Yeah.
towards. I really like how you framed the article's framing around insurance premiums are indicative of they're sopping up the mistakes we're making as a society
Yeah.
around building codes
Yes.
and other things,
Yes.
right? At the
Yes.
end of the day, insurance reflects risk.
Yes. It has
And
to, right? Yeah.
and so our consensus goal should be we should be reducing risk over the long term because it will make society wealthier. We will be more
Yes.
resilient. The long-term costs go down because we will have fewer losses, smaller losses,
Yes.
and those things. So ultimately, but that's the thing, Kate. I don't think there's anything I can say that fixes anything in the short term.
Yeah. Yeah.
Everything that I'm suggesting is a long-term fix. I
Yeah.
don't think there's anything that can be done in the short term other than shop and take on more retention.
Yeah.
If you have done you've made your home strong, you have
Yep.
window shutters, you got a new
Yeah.
roof, and you're not getting compensated
Yeah.
for that on your insurance policy,
Yeah.
set up your own private rainy day fund.
Yeah.
Take the biggest deductible that you can take.
Yep. Yep. Yeah, I love the way you just talked about us being a wealthier society. That just kind of I was smiling because that's why I would say it differently maybe, but that's why I do this work, right? I mean, what I worry about is insurance prices are increasing for a variety of reasons. We touched on weather, catastrophes, pricing, regulation, building codes, but there's also litigation, more complex systems in cars and houses, labor costs, et cetera, right? Endless number of things. What I worry about is that if we don't take cost out of the insurance market, which mostly means losses, because that's most of the cost for most of the lines of business we're most familiar with, insurance will end up as a luxury good and families will not be able to protect themselves. I mean, almost every great thing in history that was ever built by humanity had an insurance company standing behind it, silently, obviously, right? But like, you can't take on building a gigantic dam if you are personally liable, and if something goes wrong, they're coming after your kids' health, healthcare money, right? Like, it's not that transfer of risk is what allows the builders of this world to build great things, and so we have a responsibility for keeping that accessible to our families and ourselves so that we can do great things,
Yeah.
right?
Yeah. We have
Yeah.
to reduce cost. And I know, Kate, there will be folks that say, well, let's start with the CEO salaries. I'm not adverse to that. Like,
I
okay,
know.
Ab-
Sure, that's a great idea. It has no impact,
there's
you
no
know?
impact, right?
Yeah, big insurance company CEOs may get paid tens of millions of dollars, largely in stock options. Is that fair relative to the claims adjuster who's kneeling in your driveway looking to see if you have like a bent, radiator strut after you bang your bumper into something? No, it's not fair. It's a fundamental unfairness in American society in particular. However, if you take that CEO's salary and divide it across all $50 billion of premium, it'll save you like 12 cents personally.
Yeah,
So it's a symptom, but it's not the actual problem, right?
yeah, yeah.
Yeah,
But I think we're on the same page.
I think so too. I violently
We have
agree with you.
we have to lower costs. And I think from a regulatory environment, my advice to regulators is
Mm.
we need to start thinking outside the box. I just shared an article with someone last week. The state of Utah is
Uh-huh.
allowing HOAs to create their own captives.
I don't know if I saw your article, but I did see that news, which is interesting and also a little terrifying to me in some ways.
Of
Yeah,
course,
the
right?
geographic concentration of risk is terrifying. But if it's like, if they find a way to cover multiple
But
locations or, yeah,
there's concentration of risk, but to the conversation that we're having,
yeah,
everybody's feet's to the fire. We're all
absolutely.
This is one we are all literally
Yep,
all in this together.
yep.
So let's not mess around.
Clear
Now,
your dry brush, put your hurricane shutter, well, not in Utah, put
yes.
your hurricane
But we're
shutters
starting to
up.
see that. So Babcock Ranch, which is not too far away from where I live,
Yeah,
is a community in Fort Myers, an HOA, where they
okay.
built the entire community to be storm resilient.
Oh,
So it's been
fascinating.
highly engineered. Everyone that
Yeah,
moves in there knows that this is why we're here. Like we want
yep,
the beauty of Florida, but every once in
right.
a while bad stuff happens and we want to be able to bounce back quickly.
Mm,
They have their own electricity, their own solar panels. The homes have unusually high building standards to
mm,
them. They have great water management systems and
yeah,
such, so they can bounce back quickly.
yeah.
And it's
I
like
love
those
that.
kinds of communities, they should be self-insuring because no
Yeah,
outside
yes.
insurer
No,
is going
they're
to
not
be
going to
able to
get
do
credit
it
for that.
adequately.
Yeah,
They can model it, they can put a price tag to it.
yeah.
And this was like the conclusion of my captives article was you don't have to take one big bite, right?
No, yeah,
You can start
that's
in the
it. Yeah,
deductible and take a quota share in the
yeah,
deductible, small piece.
yeah,
That's
yeah.
it.
You absolutely can. That's so
And then
smart. You can your way
build
in. So, yeah,
surplus. And if
yeah,
you're successful at some point, now there are all sorts of dividends. I think of
yeah,
California, if you're successful and the surplus is growing, now you have a mechanism to use that surplus to do more risk mitigation, to keep it
yep,
up. Because
yeah.
the trees are starting to grow back. Let's
Right, right. Or even just the technology gets better, sensors
yes.
and whatever else. What I love about that too is that assuming and there will be failures, right? But assuming that overall this movement is successful, it's going to increase the demand for the kinds of construction and the kinds of tools they're using to create the mitigation. And some of it is probably just, a slightly different building plan, but some of it may be actual technology or construction elements that are fairly expensive today. The higher the volume, the more the demand on those, the higher the volume, the cheaper they get, the more
That's what happened.
incorporated into like other homes just because that's what's
Yeah.
available, right?
That's
Which
what
is
happened.
great. All
That's
of
what
us.
happened here in
That's
Florida.
happened.
And
Yeah.
Andrew destroyed Homestead,
Yep.
which was predominantly wood frame construction, just like
Yep.
most other parts of the country. So when Florida began ratcheting up the building codes, they quickly transitioned to masonry
Yeah.
construction, right? And that was the objection was like, this is going to be too unaffordable, right? And it's like, yes, in the short term. Kate, they built across the street, they built like a multi-hundred unit thing in months. Like the supply chain for masonry is all here now, and
So
they
much
can
better.
build
Yeah.
just as fast with masonry,
Yeah.
just as expensive with masonry as they can with wood frame, right? And so we're here, and that's another part of it is like let's play the long game and not the short game. In the short game,
Yeah.
you can always pick apart the costs, but
Sure.
let's put on our investment caps and say, is this an expense or is this an investment?
Yeah. I love that.
So this is a treat to everybody. This was an on the fly, off the cuff podcast recording with no agenda,
No outline.
no
No.
outline. We postponed this several times to make an agenda, and we just decided, no, let's instead of cutting a promo, let's just make a song. And we just wrote Stairway to Heaven.
I love that.
We just
I,
like I completely when my guitar started playing the tunes and you began playing the
started
lyrics
riffing
and
on them.
we were looking at each other like, oh my God, let's just keep going. A one in a billion, let's call it.
Every conversation with you is fascinating, Nick. I love talking to insurance people.
So Kate Terry, one of my favorite people, CEO of Surround. I will see you at ITC.
Yeah, for sure.
Okay. Thank you.
Thank you. I hope some of this was actually usable.
It's all usable. Thanks. Thanks, everybody.